We now take a brief tour through stock valuation. I want to emphasize that one objective here is to help you believe you have the liberty to innovate and come up with your own quantitative finance solutions to complicated problems. And so I'll be illustrating a couple of very technical solutions to problems that have crossed my desk. I'm not promoting these particular solutions as much as wanting to encourage you to come up with your own creative solutions and deploy them in R. We'll review the traditional dividend discount model. We'll take a brief tour through the stock market returns. We'll focus on an end-stage dividend discount model where we have unique growth for each stage, as well as a unique forward rate for each stage. The model will be illustrated, and then we'll once again apply the LSC model to the present value of dividend curve. And so the central ideas is I think it's helpful to go decade by decade through the U.S. stock market. In the long run, it's well known that stocks perform well, but very few people realize that almost every decade you have a significant loss. And we'll explore a variety of different valuation techniques based on the present value of predicted future dividends. So the graphs we're about to explore is evaluated returns from a multitude of sources, depending on what part of history I was trying to collect. These are adjusted total returns, so dividends are included. And the conclusion we'll come to is by decade, the returns to the U.S. stock market are generally positive, but each decade has a severe decline. It's important to notice a Nobel Prize winner once pointed this out at a conference. The only reason that you can be watching this particular video, seeking to do quantitative finance in this particular year, is that our country has survived. And so if it doesn't survive, then all these results no longer hold. And so this is the total return on the U.S. stock market. Clearly, a $1 invested, and the end of 2025 had approached $13,000 near the end of 2022. And so if you take the log of that series, this is a little more interpretable in that the trend of the log scale of the total return is much more convincing that it's increasing. And so what I'd like to do now is go decade by decade. We'll start out from December 31st, 1925 to December 31st, 1935. And there are two primary observations I'd like to make in each decade. What is the loss from the high water mark? For example, from about whatever that is, late in 1929 to mid 1932, the U.S. stock market declined to 84%. That is catastrophic. And we've probably all seen the food lines of people that are hungry. Unemployment's very high. This graph really doesn't do justice to the pain inflicted by the economic environment that resulted in this decline. But the other thing I want to point out, if you invested $1 at the end of 1925 and somehow went to sleep for a decade and woke up at the end of 1935, notice that you're up 50%. You start out with $1, you end up with $1.50, and so that would have actually been a 50% return over that decade. And so it would not have been a loss. In the next decade, 35 to 45, again, we see several sharp declines. Sort of the second Great Depression or the mini depression that occurred in the 30s. The market was down 37%. But if you'll notice in this case, over the decade, the market was up. $1 turned into almost $2.50. In 1945 to 1955, notice that the market near the near the end of the war was down 24%, World War II. However, the economic boom that occurred post-World War II over this next decade, a $1 investment would turn into about $4. From 55 to 65, we have the similar upward sloping trend again in the early 60s. I think this is the Cuban Missile Crisis and related events. The market was down 23%. However, over this period, the market was up. $1 invested resulted in almost $3. In the 65 to 75, we have the markets down 46%, in part due to the OPEC embargo on oil. But again, we started out with $1. We ended up with something north of $1, but less than 50%. And so this was not a very good decade, but still positive. 75 to 85, we had a couple of different declines, a down 18% in 1981, and then again in 1983-84. But over this decade, we're up from $1 to over $4, and so it turned out to be a phenomenally good decade. Similarly, in 1985 to 1995, we had October 19th, 1987, the crash that occurred then, and then the echo crash in 1989, and other declines, but we go from $1 to north of $3.50. So by now you should be able to detect a pattern. We do have severe declines, at least one every decade, but if you hold stocks for the entire decade, you end up, in this case, up almost 150%. In the decade from 2005 to 2015, again, the familiar downdraft of 48%, but being up about 150%. And from 2016 to early 2023, in this particular decade, we've had two downdrafts of 20%. And so the overall conclusion is that if you invest in stocks, you should expect to have significant downdrafts from time to time. But over the long run, you should have significantly positive performance, assuming your expenses are relatively low and you can manage the tax consequences well. We now turn to the dividend discount model. We'll review briefly the Gordon single-factor dividend discount model. It assumes a constant growth rate, a constant discount rate. We'll expand that to an end-stage model where we allow for different growth and discount rates within each stage. And then we're going to apply the LSC model to the dividend discount model, and we'll apply this in a couple different contexts. Remember, the goal of the LSC model is factor reduction, and so we're going to take the very complicated present value of dividends model, and we can still estimate it with a parsimonious LSC model. And we'll show this with quarterly paid dividends on a 2, 3, and 4 factor LSC. And so just to get a feel for what this looks like without diving into the math, is this declining line is the present value of dividends. If we assume a $1 dividend with a specific growth rate and discount factors, as you'd expect, as we move out in maturity, the present value of those dividends decline. We could actually fit this with a 2-factor model, is this gray line. If we increase that to, and by the way, the jaggedness here is due to the assumed quarterly pay, but adjusted annually. And so if we go to a 3-factor model, if you'll notice, the fit is better. It's not perfect, but it's getting a lot closer. 4-factor model, it's difficult to distinguish between the fitted line and the in-factor dividend discount model. And so we're now going to turn to the quantitative material. This is a discount factor adjusted approach to valuation. We'll look at a generic dividend discount model, then the Gordon growth dividend discount model. It's a single growth rate, single discount rate. We'll expand that to an end stage model, and then we will apply the LSC to calculate the present value, to fit the present value dividends function. And then we'll conclude this particular analysis with the unique application of different industries, trying to infer a slope for the forward curve and a slope for the growth curve of different industries based on available market information. So generically, if you recall, the discount factor adjusted approach to valuation is simply taking the present value of some probability times the cash flow. We're going to sum across all the potential states at a point in time, and then we're going to sum across all the particular points in time. Generally with stocks, we assume an infinite time frame, and so we need to simplify this model a bit in order to do any kind of analysis. Before we do this simplification, this is an illustration of Southern Company over a 10-year period. This is the illustrating the fact that dividends are typically paid quarterly in the United States. That's not true in other countries, but here it's typically quarterly pay and annually adjusted. And so what should be clear is it ought not to be that difficult to predict future dividend streams in light of these past dividends. And so, but any kind of dividend discount model that doesn't incorporate this quarterly structure is at least logically flawed. Hopefully it's not causing a severe valuation difference, but it is something that we might as well address, particularly in this day and age of having sophisticated computer power. And so the generic dividend discount model, the way I like to think about it, is simply the sum over all the future dividend payments of the present value of the dividends. And so you can think of this as the key vector, the present value of dividends, or the dividend present value. And basically what we're going to do is we're going to take the expected dividend payment at some future point in time. We're going to discount that at some appropriate discount rate. And then we're going to sum that up across the perpetual cash flows. And we come up with the fair value of a stock using the generic dividend discount model. Some of the competing issues is the expected dividends are rising. So you would expect these dividends to increase over time. And the discount factor, assuming positive interest rates, you'd expect the present value of dividends, or the present value of $1, to be declining over time. And hence, you've taken a declining factor times an increasing factor to come up with your valuation. And so these results are very sensitive to the choice of interest rates or discount rates and the choice of growth rates of dividends over time. And the next part will begin to look at different specific models, and we'll start with the Gordon growth dividend discount model.